Hey everyone, and welcome to this explainer. Today we're going to unravel a bit of a financial true crime mystery. We're looking at exactly how profitless startups somehow command astronomical multi-billion-dollar price tags in today's market. I mean, if you follow the tech space at all, you see the headlines constantly, right? Companies burning through millions, sometimes billions of dollars, yet somehow they're being celebrated with record-breaking valuations. So let's figure out why. Section 1. The billion-dollar paradox. Take a look at this number, $300 billion. That is OpenAI's valuation in early 2026. And this is despite the fact that they operate with steep structural costs and burn through an incredible amount of cash. Just to put that into perspective for a second, that price tag is actually larger than many of the world's most established, highly profitable global corporations. Which brings us to our core paradox. How do you value a company that loses money? Seriously, how do venture capitalists legally and mathematically justify these prices when a company hasn't made a single dime of net income? To outsiders, it just looks like a bunch of speculative excess. But once you get inside the industry, you realize there's actually a highly specific, engineered logic at play here. Let's move to Section 2, the power law and the J-curve. So the crucial thing to understand first is that early losses are a planned feature. They are not a bug. Startups intentionally undergo this massive capital-intensive growth phase known as the J-curve, where they experience compounding net losses. They're deliberately burning cash to build infrastructure and grab market share before competitors can even blink. The whole expectation is that once their network effects kick in, customer acquisition costs plummet, and the business sharply climbs up the right side of that J straight into exponential profitability. To really grasp this, you need a total mindset shift. The legendary venture capitalist Bill Gurley puts it perfectly. He says, venture capital is not even a home run business. It's a grand slam business. Investors aren't looking for safe, steady bets. Absolutely not. They are actively hunting for the rare, massive outliers. And that grand slam mentality is driven by the power law. In standard asset classes, returns usually follow a normal bell curve, right? Well, in venture capital, roughly 90% of a fund's entire returns are driven by just 10% of its startups. Because of this wildly skewed distribution, fund managers literally have to optimize for massive scale. They need those few runaway unicorns to get so unbelievably huge that they pay for the inevitable graves of the other 90%. And that, right there, is what sets the stage for these unicorn valuations. Let's look at Section 3, the math behind the magic. Okay, so during the downward slope of the J-curve, when a company is just bleeding cash, traditional cash flow models are completely useless. So what do investors do? They turn to pioneers like Professor Bill Salmon. Back in 1987 at Harvard Business School, he created what is still the dominant pricing mechanism for early-stage companies today. It's called the venture capital method. It's basically a four-step financial time machine. First, investors project the company's financials all the way out to a hypothetical future exit, like an IPO. Second, they predict a revenue multiple based on industry standards. Third, they apply a massive discount rate. We're talking 30 to 60%, just to compensate for the extreme risk that the startup might fail and the fact that their shares are locked up. Finally, they calculate the present-day value. By working backward from a hypothetical future triumph, this exact method allows VCs to mathematically engineer a multi-billion-dollar price tag today for a company that is currently operating entirely in the red. Section 4, the AI valuation premium. Now, when we apply these frameworks to the 2026 AI boom, we see a really stark bifurcation in the market. Standard public software companies trade at a median for about 3.4 times the revenue. But AI foundation models, they are averaging a staggering 37.5 times revenue. Investors are paying a massive premium here, completely based on the belief that AI infrastructure is going to create winner-take-most monopolies that control the baseline software of our global economy. Just look at this Q1 2026 data. This is the real-world application of that venture math. You have OpenAI trading at over 80 times revenue, Anthropic at over 70. Now, how on earth do funds justify these staggering multiples? Well, it comes down to unprecedented revenue expansion. When a company 10x's its revenue in under 18 months, that scary 80x price tag actually shrinks down very quickly to a much safer-looking number, allowing growth equity funds to defend these initial premiums. Moving on to Section 5, the circular economy loop. Here is where things get a little bit wild. Where is all this money actually coming from? Well, these astronomical valuations aren't just driven by organic, everyday software demand. They are fueled by a recursive capital loop. Analysts are literally calling it a financial Ouroboros, like the mythical snake eating its own tail, where value just continually feeds right back into the exact same ecosystem. Let's actually trace the mechanics of this loop. Step 1, massive cloud providers and chipmakers invest huge equity checks into AI startups. Step 2, those startups turn around and use that exact capital to buy hardware and compute directly from the companies that just invested in them. Step 3, the supplier's revenues obviously spike massively. And step 4, they use that newly generated cash to fund even more AI startup equity rounds. If we follow the money, everyone is essentially financing everyone else's compute. And that creates an escalating valuation floor that is completely independent of traditional math. Which brings us to our final section, bubble or sustainable boom. The scale of the stakes here is just staggering. Take a look at this. $750 billion. That is the projected 2026 capital expenditure from tech giant hyperscalers. We are talking about $750 billion, relying directly on the integrity of this circular ecosystem to hold up. But as you can see in the data, there is a looming tension. There's a massive $800 billion shortfall gap between the infrastructure being built right now and the analyzed end-user revenues required to actually justify it. Sure, the loops of capital moving between big tech and AI labs generate immediate paper profits, but they hide a rapidly widening gap between what's being spent on compute and what everyday customers are actually paying for. And this circularity has created what's being called the grand divergence. We have extreme haves and have-nots. Mega-cap AI leaders are absorbing basically unlimited capital as the consensus winners, driving their valuations to the moon. Meanwhile, smaller software companies are facing intense capital starvation. It's a deep concentration of wealth that has regulators and allocators seriously questioning if the underlying foundation here is secure. So I'll leave you to wonder about this final question. Is this a strategic infrastructure build-out or a systemic fragility? Are we laying the indispensable tracks for the next industrial revolution, where early losses are just the cost of entry? Or are we simply watching a financial Ouroboros get ready to eat its own tail? Because in the high-stakes world of venture capital, a billion-dollar valuation with zero profit isn't a mistake. It is a highly engineered bet on capturing the future. The only real question left is whether that future will actually be able to pay the bill. Thanks so much for diving into the numbers with me today.